So charitable contributions, corporations can make charitable contributions, and they do make charitable contributions, but they are limited on the amount that is deductible to them. So they're permitted to contributions to qualified charitable organizations, so the same rules as to what constitutes a charity for the charitable contributions deduction for individuals applies to corporations. So same rules as to who qualifies, what is a qualifying organization, but the deduction is limited to 10% of taxable income before any of these items. So before charitable contributions, obviously we want to include that because otherwise we'd have a circular reference there. Before the dividends received deduction, before any net operating loss carryback, we haven't talked about those two things yet. We will talk about them. And before any capital loss carryback. So we have to, let's see, and is it just the carryback or is it the carry forward as well? I'm going to click on this for a second to see. Oh, that doesn't really help me. All right. So 10% of taxable income. So not 10% of the deduction or of the contribution, but 10% of taxable income. So if we have a contribution of $5,000 and we have taxable income of $60,000, what we're going to multiply the 10% by is this. So our limit is 6,000. So in this case, we could take all of that charitable contribution, right? If, however, our taxable income was $40,000, then our limit would be $4,000. We can only take 4,000 of that 5,000 as a charitable contribution. Okay, so make sure you're multiplying the 10% by the correct amount. You don't multiply it by the contribution amount, multiply it by the taxable income because that's the limit. So any contributions in excess, and by the way, this creates another book tax difference because on our books, we would have expensed that entire charitable contribution. But on our tax return, we are limited to how much of that contribution we can deduct. Or it could be that we had a contribution in a previous year that we're now deducting this year, but we expensed it completely on the books, but now we're taking it as a deduction. So it can work either way. I just point this out to kind of get you ready for the issues that we're going to talk about with that M1 form. So any contributions in excess of the permitted amount are carried forward for 5 years. So here's our $4,000 limit. We had a $5,000 contribution. So we have a $1,000 carry forward. We can go up to 5 years. Forward only. Forward to 5 years. They're added to the charitable contributions in the next year. And that 10% limitation still applies. So it's as though if you have this $1,000 and then next year you contribute another $5,000 contribution, now you've actually got a $6,000 contribution because we're going to add that $1,000 to it. Total contribution is $6,000, but we're still going to do this calculation, this limit for it. Okay, so it's important for corporations to manage their contributions if they're concerned about the tax effect of it, right? So in future years, also the current contributions are deducted first. So again, that $5,000 would be deducted first. This $1,000, if we don't have enough taxable income to absorb that $1,000 is going to get carried forward another year. And remember, we've only got 5 years that we can use that. This is where tax planning comes in. So for 2020 and 2021, and only for those years, the 10% limitation was increased to 25% of taxable income. For 2022 and later, it went back to 10% because they wanted to encourage corporations to donate to charities during COVID, right? They also had a special charitable contribution deduction for individuals that was, you didn't have to itemize your deductions. People were allowed, I think it was $250 or $300 per individual cash only contribution. So non-cash didn't count. If it was non-cash, you still had to itemize your deductions, but you were allowed a contribution, a deductible contribution without having to itemize. But again, it was only for those minimal years. But it's gone back to just the 10%. So here we've got Szabo Company. They had $50,000 of taxable income before charitable contributions. The company had charitable contributions of $8,000. Their charitable contributions are going to be limited to 10% of their taxable income, so $5,000. Their taxable income now is going to be reduced to $45,000. So now they're going to pay tax on $45,000 rather than $50,000. But they've got a $3,000 charitable contribution carry forward that will last for the next 5 years unless they don't use it up. And any future contributions are going to come first in that calculation. If a corporation contributes ordinary income property, so inventory and accounts receivable, the deduction is limited to the corporation's basis in the property. So if not the fair market value, so the value of any ordinary income property, any inventory or accounts receivable is going to be what the basis is in that property, not what its fair market value is. Normally, you get a deduction for the fair market value, but for ordinary income property, you get a deduction for the basis in that property, so what you paid for it. So this is property that, if it was sold, would produce a gain or other than a long-term capital gain. Example is inventory. Taxpayers will use the carry-forward information to determine any charitable contributions limit, but ignore carry-back information. Excuse me. Taxpayers use all information available when the return is filed, but do not make changes for why is this saying that? For information that could become available in the future. Forward, but ignore carryback. I'm really not sure what that sentence means. I'm sorry. It's not related to that. Maybe it's regarding the ordinary income amount. Anyway, sorry,